Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, December 16th, 2019. I was out of the office on Friday, so didn't do a typical weekend or end of week market wrap. And I'm also going to cut these down since there's just not, haven't seen any significant developments now for quite a while in the broad market. So as I said recently, I'll cut the updates on the general broad market analysis down to a couple times a week unless we get any technical developments. Now on that, I'll make mention. I had a couple questions on the site. I'll kind of fill in the blanks here, not the blanks, fill in the gaps in time here with some additional commentary other than the broad markets, because again, we're in a slow grind up. And when I say slow grind, the market is in a persistent uptrend, following that little correction last week. But really, we're since the breakout here, we had a breakout above 302.46. This was our breakout to new highs right there. We had pretty much double topped. So our high back in July, mid-July right there. Again, September, and we're up as of today 5.5%. So it's not exactly a runaway market, but it's a slow and steady grind. Today was, one of the bigger up days recently, about 0.7%. We'll talk about a few things here today and go over the charts levels to watch. First off, somebody asked today on the site, about the divergences. It's a big part of my trading, but I always say divergences are, number one, they're not the be-all, end-all. You don't have to have divergences with tops and bottoms, but they certainly are something to watch. And they can continue and often do continue to build for a while. So just like overbought conditions, we're going to get to some of those in a second. But just like overbought or oversold, divergences are not a buy or sell signal. And somebody asked, well, when would these be taken out? So as far as a daily time frame goes, if we expand this right here, here's your PPO, there's your previous divergent line that followed that 20+% drop into January or December 25th of or 24th, Christmas Eve of last fall. This is the current divergence right here. So your previous peak right there in the PPO was there, and so to take that out, you'd have to take out the previous this reaction high back here. And the answer to the question, let me just say, was this: there's no easy answer because it's a function of not just price. It would be easy to say, somewhat easy to guesstimate if SPY went up, today or in a single day, if it went up 5, 8, 10%, the PPO and the RSI would both go on and take out the previous highs. However, it's a function of two things: time and price. So what happens is there's many possibilities. Let's just say the market were to trade sideways for a while. What would happen is the indicators actually wouldn't go sideways. If we were to trade sideways from here, they'd go down, and that is because when you're heading up, you have a positive slope. If the slope flattens to a zero slope or no slope, that is a change in momentum. The momentum went from up to down. Obviously, that's a more abrupt change if you reverse. But the point being, there's a lot of variables. So you could correct for a while. You could keep going up. Now, if we just keep going up at this slow and steady rate, it'll probably, I would say, within the next 8 or 10%. And again, by taking out the divergences, it doesn't mean that all of a sudden it's opened up the door for a multi-year move. It just chips away at certainly some bearish technicals that are in place on the chart. So I wanted to kind of address that, and we'll watch that. As of now, they're still very much intact. Their SPY again up about seems like a runaway market, but it's up as of today close. I think it's about just around 5% above the breakout of that previous high back in double highs back in July and September. So the breakout's intact. We had a little pullback so far, but we haven't back tested. And so if you do get a correction, that 302.46 area, give or take, would be a natural support level on any pullback. QQQ, same story, continues to work its way higher. Divergence is still very much intact right now. Not in jeopardy being taken out anytime soon, but yet, as I've been saying for weeks, we don't have any sell signals. The closest thing we came to anything, and it was just a short-term sell signal, was a few weeks ago when these bear flags played out. So just to zoom down now, since there's nothing significant to report on the daily chart, show you some trend lines to watch on the 60-minute charts. You have an uptrend line right here, that magenta trend line, and the divergences that we had in place when that bear flag played out a week or two ago is still very much intact now. It's just extended. So there's your divergence line right now, and you can see down here, I'm going to show you this on the futures as well in a second here, but we're at a pretty much an extreme overbought reading. That levels, I have a magenta line there at about 78.30. 70 is considered overbought, but really, if you know, in an uptrend, overbought often becomes more overbought or stays overbought for an extended period of time. So what you want to do is, I like to do at least, is on any security come up with my own line for what is overbought and what is oversold for that particular security. And in this case, you can see that the RSI has only reached that 78 level a few times in the past couple months, and usually when it gets there, at the very least, the near term, you get a little bit of a drop, a little small correction, and sometimes quite a bit more, depending on where it is. And sometimes you get that one extreme reading followed by another lower reading, and that gives you, as you can see right there, divergence right there, divergence right there. In fact, let me show that to you now, and then no, let's roll into SPY, and then we'll get to the futures, and then I want to share one other comment on the site today. All right, SPY, same thing. There's your bear flag, if you can make it out there. There's the flagpole flag, and hit the measured target. Hit my 307.27 target right there on the gap down, and that was the bear flag target, the measured target. And from there, after that 307.27 target was hit, we worked our way up, and you can see now, again, let me color code these lines. That's what I'm watching right now. And let's color that up with a trend line. If I can grab the line tool, there we go. So there's our divergence line, but this is the one we watch. Divergence lines can be moved. They're not as important. Sometimes if you get a lot of reactions on the upper trend line, you can trade off that or expect reactions, but when you only have a couple points, I would say, you know, when you're in an uptrend, divergence lines can be lifted. But if we go much higher, then the divergence is taken out here, or will be taken out here on the 60-minute chart of SPY as well as QQQ. But as of now, that's what we're at. So looking at this, that's your little wedge pattern right now to follow. Zero sell signals, but if we do pull back, you have a gap right here to be backfilled, and that also comes in right around the bottom of the wedge. Bullish case would have the buyer step in there, but a break of that level probably brings you back down here to at least, let me give you one other shallow target. The trend has been pretty healthy right now, so that would be the first, and it's a small pullback. And you might be wondering, well, why are you looking at these 1%, 2%, 3% pullbacks? And that was the other question on the site. Somebody made mention about, oh, the market keeps going up, Randy, and all you're giving are these pullback scenarios. And I've said this several times on the site. My trading style is very largely based or predicated upon or incorporates support and resistance levels, trend lines, chart patterns. When you have a security, whether it's the stock market or anything else at all-time highs, you have absolutely zero support levels to trade off of. The only way to gauge how far a break at a security trading new highs may go, there are various chart patterns, and I also incorporate that. Had we broken out of, let's say, some type of a consolidation or continuation pattern, you can take a measured target for that pattern. Most chart patterns have measured targets, and apply it, just like on the bear flag scenarios that we had last week on the pullbacks. So remember, the public content, what I do in these end-of-day videos, if I'm not covering everything else out there, which is 90% of what I cover and trade, just general stock market analysis, that's public content. I will tell you what I see with my style, and that's a lot easier to call and trade the pullbacks, even if they're going to be small during an uptrend, because you have, like I just showed you here, well-defined support levels, well-defined uptrend lines in which to trigger reversals or sell signals. You can look for bearish reversal patterns. You don't have bullish reversal patterns in an uptrend because you're in an uptrend. There's no reversal. So I just wanted to share that. And at the end of the day, most importantly, is what I said in there, is in recent months, and this is going back months now, easily easily 90% of the trade ideas that I've shared, individual stocks and individual sectors, ETFs and commodities, have all been long side trade ideas. So, if you're, on one hand, if you're just looking and trying to trade the market and going off that analysis, well, like I said, we've been in an uptrend with very little sell signals other than short-term pullback signals. We never broke down, going back for weeks now. When we're back here, this was a level I've been watching and still am, 8,200. All we've done is test it, going back into early November. Never broke it. And that was a level that I believed and still do needs to be taken out to open the door to much bigger sell-off. So, like I said, right now the market's walking higher with very little sell signals. If you're an active trader and you want to game the next pullback, I'll show you some levels to watch again here on NQ. These are the Nasdaq 100 futures. There's our comparable trend line that I just showed you on the 60-minute chart of QQQ. This is a 60-minute chart of NQ, the E-mini futures. I could actually add a minor trend line there that could pop overnight. If that breaks overnight, you can see this would be your logical first target, first support level, this trend line. This is more significant, much more than this minor one. But there is a little small wedge. Break of that would probably bring us here, and then a break of this trend line, this one right here, would trigger probably your next 2 to 3% plus correction. First support right now from where we're at is right here, 84.58. You can see that's a pretty decent level on NQ, and I'm going to color that right there. You can see we had a couple reactions there and we broke above it. So these are the levels to watch in blue right there, and they come in close together. So break of the trend line and then 84.58. And there's quite a bit of support below, but you can see I don't have a target resist or support level all the way down to about 83, 82. What would that mean if we get down there? And let's just say, should we pull back soon? That's only about a 2.25% drop, not much, but we'll just have to see the nature of any pullback as it comes. And again, these are the levels I see. This is what I can trade off of. Looking above, there's nothing there. You can, your guess is as good as mine. Elliott waivers can apply wave counts. You can use things like Fibonacci projections and other things like that, although I find those kind of hit or miss, to be honest with you. The Fibonacci projections that'll, kind of predicts how far something will go. So that's it. Those are levels to watch, and should we trigger a sell signal, there's certainly the potential for much more if this 83, 82 level goes, but we'll just have to look at the nature of a pullback. For example, like those flags the other day when they started to form, we had the divergent high here. It was only at this point, once we had that impulsive leg down, and then we set up the flag, and I pointed out at that time we were bear flagging, so then I could apply a measured target, and that target came in right around that 8200 level, and it also came in perfectly with ES as well. And so that was where, at the time I mentioned reversing, short to long. Didn't stay long that whole time, but at least reversed on the bounce. And again, back to what I was saying, this is a very small part of, at least recently, I've cut back substantially on my NQ and QQQ, those trades of the indexes. And for months now, the trade ideas have been in, lately it's been energy stocks I've been highlighting, and those are looking better and better now. A little work to be done in oil and natural gas. We've had trades and several trades, official and unofficial, on Bitcoin. That's setting up again for the next trade, but we've had a big down move there. We caught an up move, I think two long trades. And these are all 20+% drops. I think it was about a 15-20% rally on the last long trade there. And these are things that have nothing to do with the stock market. Lithium stocks, I updated again today, a second video. I did one a couple months ago highlighting those. The generic drug stocks, couple months back, I went over, I think it was 30 or more individual stock setups in the generic drug index right here, subsector, if you will, back here before we even broke out. And a lot of those stocks are up 20-30% and more. Biotechs, that's another sector. And again, these are all long side sectors. These are all trade ideas, not a single short in any of these sectors. And again, the point being is that I do the videos on the market. I'm showing you levels, pullbacks, divergences are building. Expect a big drop will come sometime soon based on those divergences and other things. But until then, I might beat the bearish drums on the broad market, but these are where the trade ideas have been. So here's the biotech sector where we've had trade ideas, on all types of stocks, including things like Clovis here, highlighted right here. That that one popped, for about 207, almost 300% from where it was mentioned right here after the breakout. And so that's where the trade ideas have been, and will continue. Oh, not to mention all the commodities: coffee, soybeans, wheat, and of course the hard commodities as well: crude oil, natural gas have been on hold on the sidelines as far as swing trades for the precious metals. But that's those are the things I'm watching, and this is where the money's to be made. Coffee has rallied. It was pointed out here in this divergent low, and in just a couple months it's rallied 46%, whereas the stock market has gone up 5.5% since the last breakout to new highs several weeks back, a couple months ago or more. One other thing before we wrap this up. I just wanted to revisit some economic indicators, and what I did in not cherry picking the rally, the strength in the market, and there's been just a dramatic and really sudden shift in sentiment where all of a sudden it seems that recession fears have just almost completely evaporated, and everything well, not everything, but most things that I'm seeing and reading and hearing are people saying, well, the recession risks are gone now, get in the market. This market is going a lot higher, and I've literally seen articles that say there is no risk in the market. Now I know everyone has their dramatic opinions and will say things like that, but that's silly to say there's no risk. But that is what's driving this, and I recognize that a lot of, but not all the indicators. We had retail sales missed on Friday. I was out, but I noticed that retail sales missed, and I wanted to just do an update here. I went back to the last video that I did with some fundamentals on the market, and that was dated on November 15th. Now I didn't go through a lot. I just picked a couple which I think were important ones, and one of those is U.S. industrial production. Again, this was back on November 15th, and at that time I pointed out that we had seen and were in the middle of a drop in industrial production. Again, this is a very important component of the economy. A drop that we hadn't seen anything since 2014, 2016, when the large cap, almost all indexes went to a bear market. The small caps, mid caps, most sectors dropped 20% or more, so they officially hit bear market territory. Large caps just managed to dodge that designation by a couple percentage points, and that was, again, it was a sideways market. It doesn't show here. I'll cover that before. You can pull charts. It was about 2014 through 2016, or 2015 to 2016. It was almost 2 years of a sideways market with two big corrections in there, and again, we'll call it a near bear or whatever. And so I just took a look today. Haven't checked it in a while. We were right here. What is that, about? I'd say 1700 on industrial production. And as of today, it's the same chart. I don't have it blown up here. You can see that this continues to fall, and this to me is an important one. These are the ones I watched. That's why I included it in that video. We were actually right here at the time, right there, and you can see we had a little blip up, and we continue to fall. That's the most recent industrial production numbers, and you can see here, it says industrial production dropped 1.1% in October 2019, following a 0.1% decline the previous month. It is the biggest annual decrease in industrial output in 3 years, blah, 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 blah. So, what's going on is some are chalking this up to the trade war, saying, oh, yeah, but that's an aberration. Well, you got to watch out for that. This time it's different, or using exceptions, it can be dangerous. I just want to point out that the fundamental picture, the macro picture, in my opinion, we're still not out of the woods yet. I just wanted to make that point. And then in that video, the only other indicator that I covered is one that I like to use. Let's see if I can jump ahead. And that is the credit spreads, high yield credit spreads. So here's that chart, and what I showed you back at the time is what I did, and again, that's a screenshot from the video, is I showed you that I like to flip over the Nasdaq. So on the top, the blue line is a Nasdaq inverted. It helps you to visually see divergences between high yield credit spreads. This is in the red line here, the U.S. High yield triple C or below. Those are the bond ratings on the junk bonds. And so when credit spreads start going up, and the spread is between treasury bonds, when the credit spreads start to go up, that tells you there's something wrong in the credit markets. And smart money will typically watch credit markets closely for clues. So when the blue line, you can see the divergence better when I invert this. So this is the Nasdaq rallying, and it rallied as credit spreads were going up. Had a little correction, but it continued to rally up to this point. And remember, that was back. Here's that 2015 to 2016 period where we had that big drop, the big correction in the market. Now, as I pointed out back then, you know what, I truncated this. This is just a screenshot. I kind of jumped ahead in the video, and I can do that here. I didn't have it bookmarked, but here's what I'll do. Let's just get to that chart right now and show you what I'm talking about. Okay, so there it is, same chart. It's not blown up or anything. This is live right off the site right now, and it's not updated. It's only updated once a day, I believe. But there it is. So this is where, and again, it doesn't look like much because of the scaling here, but this was that near bear market in the Nasdaq, and the Nasdaq Composite may have hit the 20% drop designation. That was it right there, and at the very least it went sideways for 2 years, and that was again the worst, up until the big drop we had last fall, the worst correction that the market had had in many years. And you can see again, it was noted by credit spreads going up while the market continued to rally. So the divergence between the two. And I just wanted to point that out, that's still going on now. You have credit spreads continue to rise, and the stock market continues to rally. Remember, blue line going down is the stock market rallying. So there's that divergence, such as we saw leading up to that big drop back then when the two were diverging. And the divergence I'm talking about, that's it right there. Red line up, blue line down. And so again, not to cherry pick, I just wanted to go back to the last time I had posted some economic indicators, at least up on the video channel. And so we'll see. But it all comes back to this. This stuff I've seen this before. Divergences between indicators like this, overbought conditions, negative divergences can go on and on and on. And sometimes they go on and they don't even play out. But they are worth noting. So as of now, everything's still intact. The trend is bullish. We have zero, I'll repeat, zero sell signals at this point in time. Just like we had last week, but there's your levels to watch that might change that, break of that trend line, and you'd want to see them all go. They'll probably all go together. The futures might go first, but SPY, QQQ, watch those 60-minute wedges. Anything more than that, if that were to trigger and we get some sell signals, we'll see how they look. How does it look on the daily chart? Do we have any, let's say, a big bearish engulfing candle, something like that, that might then lead to a more powerful sell signal. Until then, like I said, the trend is up, and I'll focus on better fish to fry elsewhere. And again, most of those and most of my positioning are long positions in various commodities. Some sectors, individual stocks, and I'll wait for the next pullback trade on the markets, and I'll keep doing these videos and telling you what I see, and if anything changes, I'll let you know. But as of now, the long-term picture remains intact as it has for a while, with the divergences and overbought conditions that I just showed you on the 60-minute chart. Here, and if I didn't do that, I'll wrap the video up here. I posted this on the site today. Somebody asked about NQ, and that's it. This is these are my orange and red zones, my extreme overbought lines on this is an RSI 9. Sometimes I'll use RSI 14 on daily charts, even on 60-minute charts, but on this 60-minute futures chart of NQ, I have an orange line at about 86 and then a red line at about 90, 87. We'll call that 91. And you can see all tags. We just hit that the other day, so we're at that red zone, if you will, or extreme overbought zone, and you can see the circles above. What's happened? This was the smallest correction we had, but it was a correction, and in every instance so far we had a correction where the market either had an initial pullback and then dropped quite a bit, and you can see the scale of the drop. So again, little stuff. The trend is up, No, make no mistake about it. But when you hit these extreme overbought, it puts the odds at more upside, at least in the coming days. And I'm talking tomorrow or Wednesday by latest. Odds favor a pullback to at least that trend line that I told you to keep an eye on. That would give us the next sell signal. At least a pullback there, and based on everything else, you also have negative divergence, like you did back here, like you did back there, where you could get something larger along these lines. All right, we'll wrap it up here and pick this up tomorrow if there's any significant developments. Otherwise, I'll continue to probably skip a day on the general market analysis because it's same old for now, just a slow grind higher. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.